go, they could get in financial trouble, and they are so big they could take out the U.S. financial system, and it could happen in 10 years. 9 years later, it happened. 9 years later, it happened. Freddie Mac and Fannie Mae would never have existed in the free market. They only existed because the government guaranteed their financing. When they went broke, they were leveraged 1,000 to 1. They had $1,000 in debt for every dollar in equity, and they owed $5 trillion. And remember, a trillion is a million me. You now owe $5 trillion. Congratulations. Interesting politics played a huge role in Freddie Mac and Fannie Mae. I was personally on a committee of the Financial Services Roundtable for 9 years trying to do something about Freddie Mac and Fannie Mae. And we were running the numbers, and the numbers showed that they were absolutely going broke. Anybody in here would have said, boy, these guys are going broke. A 15-year-old would have said, these guys are going broke. We met with Congress on numerous occasions trying to get them to do something about Freddie Mac and Fannie Mae. And interestingly enough, they refused to do anything. And they refused to do anything for two basic reasons. One was their, I'd call it a religious belief in affordable housing. And secondly, Freddie Mac and Fannie Mae were huge political contributors. They were one of the largest contributors to the Republican Party, and they were the single largest contributor to the Democratic Party. So despite overwhelming evidence, they allowed Freddie Mac and Fannie Mae to get in financial trouble. In a very fundamental sense, the causes of the financial crisis is because the Federal Reserve printed too much money, and it ended up in the housing market because of Freddie Mac and Fannie Mae. Give you a little kind of basic background to explain how all that happened. Banks are what's called financial intermediaries. And the role of the banking business is to pool various kinds of risk, interest rate risk, credit risk, liquidity risk, and it allows longer-term investments. A simple example, an individual wants to build a residential subdivision and needs $30 million. It's not big enough to go to the capital markets, maybe too much for him to finance out of his own pocket or with his friends, so he comes to a bank. A bank can do a multiple number of residential developments, and it can do manufacturing plants and make consumer loans and diversify those risks, which actually allows people to make longer-term investments. There are no healthy economic systems that don't have healthy banking systems. However, the way banks finance themselves is they borrow short and lend long, so banks are never liquid. They never have all the money in the bank because they've lent it out. What strong banks are solvent. They have more assets and liabilities. But they're not liquid. We had a real big warning flag with the early failure of Bear Stearns. And this is where the government missed a huge opportunity. They actually saved Bear Stearns. If they had let Bear Stearns fail, market corrections would have taken place. But the market didn't know what to do with that information because they had saved Bear Stearns. Banks are leveraged about 10 to 1. That means they have about $10 in debt and every dollar in equity. Investment banks are leveraged 30 to 1. That's why they went down first in this crisis. SEC actually has encouraged before the crisis investment banks to leverage more, which is an ironic kind of phenomenon. The investment banking model was changed by the agreement they had with Spitzer, some of you probably remember. Before there was a Federal Reserve, banks were only leveraged 1 to 1. They were much stronger from a capital perspective. All right, with that background, how did residential real estate, how did it impact the capital market so dramatically? If you look at residential real estate prices, ultimately they're driven by affordability. People can only buy houses they can afford. At the peak of the residential real estate valuation, house prices in the U.S. were about 30% too high. Now that varied a lot. In Southern California, they were 50% too high. And Winston-Salem, North Carolina, where I lived, they were 10% too high. But anyway, nationally, they were about 30% too high. Initially, house prices fell nationally about 20%. Banks and other financial intermediaries were financing these houses. They lost about $500 billion in capital. Banks are leveraged 10 to 1, investment banks 30 to 1. Let's just use 10 to 1. If you destroy $500 billion in capital, you destroy $5 trillion in liquidity, $5 trillion worth of lending capacity. Banks initially scrambled to raise some more capital. They got about $200 billion, but there was about a $300 billion shortfall. So $300 billion times 10, there was about a $3 trillion in lost liquidity, lost lending capacity, including the ability of banks to lend to each other. There was the market started getting a little bit panicky, a little worried, and here was the fear. House prices had fallen 20%, but they should fall 30%. If that happened, there's another $150 billion worth of capital going to be destroyed. That's another $1.5 trillion worth of liquidity that's going to go. Markets got skittish, but they were still functioning. And then the Fed and the FDIC made a really bad decision. A large financial institution called Washington Mutual failed. When Washington Mutual failed, they made an interesting new decision. They decided to cover the uninsured depositors. Traditionally, the FDIC pays insured depositors, but doesn't pay but about 50 cents on the dollar to uninsured depositors. What that meant is the bondholders of Washington Mutual lost more money than they expected. They knew they were going to lose money, but they lost much more money than they expected. And it was kind of a wake-up call because they said, well, if I'm lending money to a bank, I don't know what the FDIC will do. I can't really predict what my losses are going to be if times get bad. When they made that decision, the capital markets closed for banks. BB&T had been in the capital markets 2 weeks before that, had no real problem getting financing. After that decision was made, the capital markets were closed. And that's why Bernanke and Paulson were so panicky when they ran to Congress for the TARP program. Housing it was overbuilt in much of the rest of the world, particularly in Western Europe, and international financial institutions had been providers of house finance in the U.S. That's what took this crisis global. How did the residential real estate markets tangibly get into the capital markets? Remember when the crisis started, the first edge was the subprime mortgage crisis. And it was an interesting phenomenon that happened in the subprime crisis. A lot of subprime mortgages have been securitized and sold in the capital markets all over the world. They've been sold based on ratings from Standard & Poor's, Moody's, and Fitch. Standard & Poor's, Moody's, and Fitch are the authorities in rating financial instruments, and they're special authorities because they have a government sanction. They're the only people who can do this. So they are supposed to know what they're doing with this special sanction from the SEC. Well, they did a horrible job. They didn't just miss by an inch, they missed by a mile. They had AAAs that were actually F, not A's that were B. So they missed huge numbers. These subprime mortgages started defaulting. The market realized that Standard & Poor's, Moody's, and Fitch had misrated these instruments, and it said, well, if they did such a bad job on subprime, they might have misrated everything, right? And so the market locked up because here was the information system, and the market didn't know what to do with that information system. It went into things you would have never expected, like the auction rate municipal bond market. The auction rate municipal bond market is where a tax-free, tax-exempt entity like a hospital or university, typically that don't have taxing authority, a hospital, university, airport authority, issues bonds to finance a project. And many of these entities got short-term bonds or variable rate bonds to finance long-term projects in a wing of the hospital. Well, they had sold these bonds in the capital markets based on insurance policies from AMBAC and MBIA, two large insurance companies who had AAA ratings. Well, the market pretty soon figured out that AMBAC and MBIA weren't really AAA because they were guaranteeing lots of subprime mortgages in addition to these municipal bonds. And if I'm an investor in Hong Kong, I don't know whether the local hospital in Emporia, Virginia is in good financial shape or not. I know Standard & Poor's has done a poor job of rating. I know that they misrated these insurers, and so I panicked. And the market started locking for entities that you could have forced hospitals and universities out of business. Now, when you have a liquidity crisis, it's a funny thing. There's a flight to quality, and BB&T, for example, was buried with cash because we were one of the stronger financial institutions, and we were able to do $6 billion worth of financing to help these entities through the crisis. But you can see the market's very rocky. One thing that kind of piled on was something that you wouldn't have thought would have done this, and a really unnecessary cause. It's called the fair value accounting. Fair value accounting is a new financial accounting concept. It's about 2.5, 3 years old. We've had accounting systems since the Egyptians, at least. We've had them for 5,000 years. So the burden of proof on fair value accounting is with those that assert it's a good system. It sounds good. It's called mark to market. The problem is that in financial stress, sometimes markets aren't working. In this case, you had the government doing all kind of odd things like saving Citigroup and allowing Wachovia to fail, so the market couldn't figure out what's going on, and the market's locked up, and they weren't functioning. And fair value accounting in that kind of situation violates the law of supply and demand in a market clearing mechanism. Simple example. Maybe I think my house is worth $600,000. Under this panic, the only price I could sell it for was $300,000. Well, I'm not going to sell it. I don't owe any money on my house. I don't have to sell it. But under market accounting, I had to the house would be worth $300,000. That had a big effect on liquidity in the capital markets. Assume there's a $100 million bond out in the marketplace backed up by home mortgages. Some of those home mortgages aren't paying, and some are expected not to pay in the future. Based on the future expectations, that